Hello and welcome to Tax Chats. I'm Scott Dyring,
And I am Jeff Hoops.
and it's good to be with you today to talk about options. So, today we're going to visit something that you have probably noticed if you have been alive, or at least maybe only if you're one of the 90 million people who follow Jeff Bezos. No, not Jeff Bezos. Who am I talking about? Elon Musk on Twitter. There's been a little Twitter trouble for Elon Musk, not abnormal for Elon, but he has been tweeting about his options. Actually, he tweeted about selling shares, but it turns out after a little digging was done, part of his motivation for selling shares may have been to deal with his stock options. So today, we wanted to talk about stock options, the tax implication of stock options, and why that is important not only for Elon Musk, but how it might be important for you if you have employee stock options, or why it might be important if you're trying to think about what's going on in the tax world with regard to companies that often report low taxes, but still have high profits and the tax deductions associated with stock options and so forth. So, as a result, we decided that we would let you ask the optionologist or the option taxologist, maybe. And Jeff's going to explain what that means because I'm still not totally sure I understand. Jeff, what does that
So
mean?
what we're gonna do is I'm just gonna ask. Guess who the optionologist is? It's you. I'm just gonna ask you a whole bunch of questions about options, and if you don't know the answers, you'll look foolish, and if you do, you'll look so victorious and amazing. And so here we go.
But hang on just a minute. Nobody even knows what it means to be an optionologist.
It's so whenever my children ask me a question I don't know the answer to, so here's the type of question they'll say, "Dad, what kind of tree is that?" And I'll say, "I don't know what kind of tree that is. I don't know the trees. I'm not a treeologist, as in a scientist who studies trees." So Scott is going to play the part of the scientist of options today, or the optionologist, if you
But
will.
I told Jeff I'm not actually an optionologist. I'm an option taxologist because I don't know that much about options, but I do know a little bit about the taxes related to options. So here we go. I'm the option taxologist. Jeff is going to ask questions, and when I fail, Jeff will answer them for you.
Yes, correct. Okay. So, I mean, we certainly are quite interested in the tax implications of options, but we don't understand what an option is in the first place. We can't do much about the taxes. So, at first, Scott Dyring is an option.
Okay, that's one I do know the answer to. So it's our lucky day. An option, sort of very simply stated, is a contractual right, but not an obligation, to do something in the future, often at predetermined terms. So, an example might be something like this: I write a contract in which I agree that I have the right to buy a share of Tesla stock for $500 a share in 2 months. Actually, how much is Tesla price right now, Jeff?
It's a lot, over 1,000. Well,
Okay.
way over 1,000.
So what we would want it to do, let's say the price of, I should look this up, but let's suppose the price of Tesla is $1,500 right now. I might write a contract in which I have the legal right to buy a share of Tesla from Jeff for $2,000 in 6 months. And that will be really valuable to me if by the time 6 months has elapsed, the share price is worth $3,000, in which case it would be bad for Jeff and good for me. But if the share price has not gone above
Like if
that
Elon
2000,
keeps tweeting
if
and it
Elon
goes
keeps
down to
tweeting
500.
and the price keeps dropping, then what will happen is I will have bought an option, but I won't be forced to buy the shares. And so I won't buy the shares because it would be unwise for me to buy them for more than I could go buy them on the open market. That's
and
what an
and I
option is.
and I'm a little bit better off because you actually pay me a little tiny bit for this right.
Right. So when we sign the contract, if Jeff and I engage in a contract, Jeff's not going to say, "Oh, I'll sell you this for $1,500 just because I'm a nice guy." He's going
Which
to
I'm
say,
not.
he is a nice guy. He just wants to pretend he's mean. Jeff's going to say, "I'm going to charge you for that contract." So I'm going to pay Jeff for the right to buy the share from him at a certain price in the future. That's an option.
Okay. So, uh, I often encounter people, for example, reading parenting books, and I'm fascinated to read the bios of these people who write parenting books, and they end up having like 0 children. And I'm fascinated that
I
they
have to
follow this
say, hang
advice.
on, stop, please. I'm not sure where you're going with this.
Okay, here's where I'm going with this. You are telling us about options. Have you, like these parenting experts who have no children, have you ever even actually bought an option, Scott Dyring, or been
Okay,
awarded one by your employer?
I'm embarrassed to say, well, let's first start with the employer. Duke University, my current employer, does not give stock options. Okay, so no,
It
I
might,
have
it
not,
might surprise everybody out there.
surprisingly enough, I have not received any stock options from my employer. I have never actually purchased a stock option,
Are
which
you,
anybody
are,
can go
are you
purchase.
ashamed of that? I have purchased a stock option.
Tell me how that went for you.
Uh, it went poorly. So, I mean, the very brief version is I was prescribed a medication by my doctor, and in doing my due diligence about the medication, I ended up, as all accountants would, in the 10K of the public firm who makes the medication. And I just thought this thing isn't sustainable. So I entered into an option agreement where I would be better off if the company's share price went down. It was like at 70. I bought the option. I think it was like at 20. And I mean, last I looked, it's like 140 or 150. So it didn't go well for me, but I did purchase an option.
Well, I have never purchased one. I'm sort of embarrassed to say.
You should be.
Maybe I should buy one right now.
I mean, if you want to, you can buy one right now. You're pretty rich. You're really rich with all that turkey money now that I think of it.
So I could take my turkey money and I could buy an option, and there's different kinds of options. So I could buy what's called a call. A call would give me a right to purchase a share of whatever company I'm interested in the future.
Tesla. You should buy Tesla.
I should. So you think I should buy an option to purchase more Tesla stock in the future?
Sure. I mean, I'm a pretty strong believer in efficient markets. Doesn't matter what you buy. It's all priced efficiently.
Okay, so here's the. All right, I am going to, I am going to go to my brokerage account right now while Jeff talks to fill the dead air. I'm going to sign in and I'm going to buy an option, but I'm not going to buy Tesla. I
Wait, why
think,
not Tesla?
well, I think Tesla, my personal opinion is Tesla's overvalued, which means
It
I
just
really,
came down by like 20%. You think it was way, way, way overvalued? And now it's just way, way overvalued?
yes, yes is the
I
right
mean,
answer.
Tesla's the future, Scott.
Well, I have another company that I think is the future.
What?
It's called Ion Q. The symbol is IONQ. And
Ion Q.
do you know what it is?
This is like Q anon backwards.
No, it's not.
Okay.
It is a quantum computing company.
Okay.
And
Little tiny itty bitty computers, like that they put, yeah, that they can put in small places.
I think that this quantum computing is the wave of the future. And so I want to have a right to buy IonQ stock for a pre-specified price.
So why not just buy the stock?
Um, that's a good question. Because today, I mean, I would go buy the stock. Actually, I have bought a little bit of their stock, but I am doing this because we're trying to learn how to buy options. So
Oh,
I'm
yeah,
going to
I forgot where we were. Okay. Now I'm
talking
back on
about
track.
options. Okay, so talk to people for just a minute while I log into my amazing account, which in anticipation for this, I discovered that you can't just go buy options. You have to be approved for option trading by your brokerage. So yesterday when Jeff asked me if I had ever bought a stock, I was embarrassed that no, I hadn't. And I was even more embarrassed to find out that I wasn't even allowed to buy
Yeah,
an
I am
option.
allowed to buy stock options in my account because again of my time with the medication in the 10K, and it's pretty fascinating. Like they ask you, I mean, so like you sign in, you put in the little ticker symbol for an option. It says your account isn't qualified to buy an option. And then I started worrying, I'm like, what am I gonna have to do? Am I gonna have to go to like option school? Am I gonna have to enroll in night courses, or what am I gonna have to do? And then you click on like qualify your account. They ask you like 2 questions and you're qualified. So it's not a high hurdle. Like basically everything in my life I've done um, didn't take much to do it, and that's what I guess Scott even cleared the hurdle if he's not
I,
deceiving us in his ability to actually buy an option.
I did clear the hurdle. So now what I'm going to do is I am going to buy an option of IonQ. Okay. I'm going to buy a call, which means I'll have the right to buy the option. How many calls should I buy, Jeff? How many options? How many contracts?
100 million.
I don't have that much money. You need to
Okay,
go much
just
smaller.
a million. It's fine.
How about I buy
I mean, if you were me, you'd buy one, but you're not me. You got
I'm
you
gonna
got the
buy
real deal.
I'm gonna buy 100 options, and I'm gonna buy them so that on December 17th, I have the right to buy a share of where's December? I'm trying to look what this works. I have the right to buy a share of IonQ at $30. Okay. And this will be it. So that's a call.
What's the current
And
price?
sorry, what did you say?
What's the current price?
The price of the option? Oh, the current price of the company. The current price of the company is 32. So this is actually in the money right now. People don't know what in the money is. Explain to them what in the money means.
That means you're actually buying the right to buy the stock for a higher price than the current market value.
That's right. So I would certainly want to do that. Why would I want to do that? I want to buy one that's out of the money. Hold on just a minute.
Yes, you want to change the price to like 100.
I'm going to have the price be 40. No, hold on just a minute. I don't want to do that. I want to have, no, 30 is fine. I want to have the right to buy it at 30, and I'm going to hope that the price goes up to like 100, and then I'm going to buy it for 30. Okay, so this is a call, and it's going to be, I'm going to do it right now. So all I got to do is click, I'm going to click review
So this
order.
costs at least $2 a share, because if you just exercised right now.
Actually, no, the price of the option is like $7 a share.
So it's at least $2, and then the $2 is just the difference between 30 and 32, and then $5 takes into account that it could go up.
Yeah, hold on though, just a minute. I must have to have some kind of a
authorization. You didn't clear the hurdle. You lied to us.
I do have authorization, but I think I have to have some kind of collateral to back.
All right, this is getting boring here.
So I'm just gonna go. I'm gonna buy one contract, and here we go. Okay, here we go. I'm placing the order. Right. Oh, I see, because each one of these contracts is for 100 shares. So I'm buying one. All right, I placed the order. It's done.
So now, what are your tax consequences as of right now? You've bought this. There's this 100 options.
Yep, it's 100 options. I just bought them. I just paid like $700 because they're $7 each. Wow, 700. Don't tell my wife that. I hope she's not watching online. No tax consequences right now. There are no tax consequences.
Which is the same as just buying a stock, right? If you buy a stock, there's no tax consequences. You don't even have to tell the IRS quite yet.
That's correct. Okay, so I bought my options. Now, in a month, what's going to happen, based on my amazing prediction, is the price of IonQ is going to go to, like, let's just say it goes to 50. Okay, so that means I can buy IonQ for 30, even though the price is 50. So when I buy IonQ for 30, I will now own 100 more shares worth $30 each, but I also paid $7 for the option. So what's called my basis, or the total amount that I paid, would be $37. And I would have built-in unrealized gain, a topic that we've talked about before, of 50 minus 37, which would be $13 per share. So I would have gain of $13 per share, but now I'm going to ask you, Jeff, will I have to pay tax on my built-in gain of $13 per share?
If you exercise right then?
Yes.
Yes.
No, I don't have to until I sell them, which is a slight difference between buying an option on TD Ameritrade or whatever your brokerage is relative to what we call employee
exercising an employee stock option. Yeah, sorry. Yep.
Okay, so now we need to do a little bit of clarifying. I won't have to do one thing until I buy these shares and sell them. And then when I sell them, I will have to pay capital gains just like I had purchased shares. My basis will be the price I paid for the shares plus the price I paid for the option. And the gain will be short-term gain if it's been less than a year when I sell them, and it will be long-term gain if it's been more than a year, and I'll pay the capital gains tax rate.
So another way to think about it is if you're just buying options on the open market, it's just like a different way to actually acquire the shares. And if you actually do exercise and own the shares, all that's complicated is like, what's your basis? Otherwise, you just Or holding shares.
I'm just holding shares. Okay, so that's easy. Now let's talk about a little different kind. There's many kinds of options. I just bought a call in the open market. There's also what's called an employee stock option. And an employee option is something that's commonly given to employees of often high-tech companies, and sometimes even non-high-tech companies like the management will get stock options. And it's exactly like what we just did. The manager is given the right to buy the shares of the company that the manager manages.
Like
Or
Elon and Tesla.
Elon. So Tesla will give Elon the right to buy Tesla shares at a pre-specified price. And Elon doesn't have to do this, but he can. The major difference is Elon is not going to pay for that contract. He's going to be given the contract because it's sort of a way of compensating Elon for his work for Tesla. Okay.
Yep. So then the question is, when do we tax and how much?
Okay, so this one turns out to be a little bit different. The first thing you have to think about is the company is going to say, you don't get to exercise those options, like go buy the stock right away. We're going to make you wait for a few years, something called the vesting period, like a waiting period.
When you vest in peace.
You vest in peace. You might have to wait for 5 years. And then after 5 years, if the employee chooses, the employee can buy the shares at the pre-specified price. And the price is typically set at whatever the price was of the stock on the date the options were granted. So if the price of Tesla 5 years ago was $100 a share, they might say to Elon, okay, you have the right to buy Tesla stock at $100 per share in 5 years. Well, if Elon, as the manager of Tesla, can make the price of Tesla go up, in 5 years, he'll be able to buy the shares for $100 a share, and if it's now worth $1,500 a share, he'll be making a lot of money. On the date that he exercises the shares, on the date that he buys those shares, he has to pay tax based on the fair market value of his gain, which would be the difference between the price he paid for the shares and the price that the shares were worth. So if the shares were worth $1,500 and the price he paid was $100, he would have to pay tax on $1,400 per share of gain.
At the individual income tax rate.
At his regular individual income tax rate, just like he had been paid cash.
Which is now like 37%.
37%. So if you're Elon Musk and you have millions of these options and the price has gone way up, by exercising them, you can have billions of dollars of income. But if you have billions of dollars of income, what do you also have, Jeff?
Billions of dollars of taxes due.
$billion.
Unfortunately.
Taxes
or fortunately, depending on whether you like to pay taxes or not.
That's right. So Jeff Bezos has a whole bunch of these stock options, which he needs to exercise. And what's interesting is the contract will say, you can't just wait until the end of time to exercise these stock options. You have a certain number of months or years after we grant them to exercise them. Otherwise, they expire. So Jeff Bezos has a whole bunch of stock options.
Elon Musk.
Why do I keep saying Jeff Bezos? He's another rich guy, but he doesn't really have options, so it's not as fun to think about him. Elon Musk has a whole bunch of these options, and they are ready to expire, which means he needs to exercise them. And when he exercises them, he's going to have a multi-billion-dollar tax bill. Where's he going to get multi-billion-dollar cash to pay the IRS?
Yeah, so that's where we started. He's got to sell some shares, and he's going to take that cash and pay the IRS. So here's a question for you. So he's doing this. So he's going to be pay taxes at his individual income tax rate on all these gains. Could have he done something different to actually pay less in tax, or was the way he structured all of this the most tax efficient way possible?
There are a couple of things he could have done. The easiest thing he could have done was not wait to exercise, but exercise as soon as he was able, because then he would pay tax at the ordinary rate. That's the high tax rate, the 37%. And then he would own the shares. And once he owns the shares, any additional appreciation will only be taxed when he sells the shares.
Not when he shares,
for a long time.
If he sells the shares. I mean, most likely he's going to die with all these shares intact in some space shuttle explosion or something. Who knows? And they'll never be taxed.
Yeah. So Elon Musk, had he exercised earlier, he would have still paid a lot of tax, but he would be saving tax relative to what he's now got to pay because he could have held the shares indefinitely and not had to pay tax.
And what's fascinating is actually in the academic literature we use, have you seen this, Scott? You use as a measure of overconfidence in CEOs the number of unexercised but in the money stock options CEOs have.
And I would say that Elon Musk fits
Be
the
a, that would
profile
be a
of an
fine measure.
overconfident
Yeah.
human.
Yeah.
It's like the definition of overconfidence is Elon Musk.
Yeah.
Actually, maybe not overconfident. So far, he's been pretty much
As
right.
far as price goes, yeah.
Yeah. Yeah.
But
So
but again, it wouldn't have, he would have saved money. Unambiguously would have saved money had he sold, because he would have been converting what is now being taxed at his individual income tax rate, 37%, at either 20% or 0%, actually, if he doesn't ever sell.
Or zero. That's correct. Now, by the way, I should remind people, if you are interested, you can chat in questions. And I have a couple of things chatted in, one of which is to point out that employee stock options are usually call options, which is the same kind of option that I just bought on my account. The only difference is I had to pay for my option, and Elon got his for free, right? Okay. Um, now there's another question, Jeff. I think you know the answer to this one. What is so the tax implication to Elon was he has to pay tax. What's the tax implication to Tesla?
Yeah, so sometimes we forget about this, but Tesla, gave Elon those options as compensation. And generally, when we give employees something valuable to compensate them, we allow them to have a tax deduction for that. So the question is, what's the amount of the tax deduction and when does it happen? So the amount of the tax deduction is pretty much exactly the same as the amount of taxable income that Elon will recognize. And the timing of that deduction is when Elon exercises.
So in other words, when Elon has to pay tax, Tesla gets to deduct tax.
The same amount.
Same amount.
Like the symmetry built in the tax code.
So that seems fair.
I mean, I don't have a definition of fair. I'm an accountant, not a philosopher or priest or something.
Well, it feels fair to me because the company gets a deduction for the amount that they paid their employee, and the employee pays tax on the amount the employee receives, which would be just the same thing as if Tesla would have paid Elon with cash. They would have gotten a deduction, and Elon would have had to pay tax on the cash that he received, correct?
I agree. And alternatively, Tesla could have sold those options to some, or could have just held those options itself. And it could have had the cash, actually. It gave up something of value, and the amount of value that it had, at least in some ways of thinking about it, is indeed the amount of value that Elon will have to recognize as taxable income.
Okay, good. So it seems like that's really shouldn't be that controversial then, or is it controversial?
That is controversial. Yes, I would say that is controversial. People get real upset when you are able to deduct employee stock options as a company because they don't think about the fact that these things actually have value. Like the company. So actually, that's a question. Why do they have the value? How is it hurting the company to give those? That's a question for you. Why? I mean, you could just give those away for free all the time, and why make them? Why allow a deduction?
So, very interesting question. There was a time in our society where companies sort of thought of options as like the greatest thing ever because they viewed them as free. And they viewed them as free. It was like a way to compensate your employees for free and get big tax deductions because the accounting rules did not require any expense to be recorded in the financial statements. So
when you say accounting, you're talking about financial accounting.
I'm talking about financial accounting that you report to shareholders, not to the government, but to the shareholders. The financial accounting didn't require any expense to be recorded, which allowed these companies to pay their employees large sums of shares, I guess, which then they converted into something other than shares in many cases. But the company didn't have to record compensation expense. So they viewed them as free. Then
which is a good thing in financial accounting. You don't want to record expenses in financial accounting, whereas you seek after deductions in the tax world.
That's correct. So for financial accounting, you want your income to be as high as you can. For tax accounting, you want it to be as low as you can. So it was like the greatest thing ever because you could report high income to shareholders and low income to the IRS.
And is that still where we're at?
So we have changed, but not to make them match perfectly. So now what happens on the day that the contract to buy the stock are given to the employee? So on the day that Elon receives his option contract, the company has to value those options and they have to record an expense in the financial statements based on the value of the options on the date that they are granted. How do you value an option, Jeff? That's complicated.
It is complicated. So use the Black-Scholes option pricing method, which is one way to do it. And it's basically this big mathematical formula where you put in several different inputs like the price of the stock and its historic volatility and other different things. And it pops out a number that is the price of the option. And
At
you use
least
that.
Theoretical
The
price.
theoretical price of the option. And I mean,
So
it's a whole question whether anybody in the real world who's actually buying option ever uses that, but the tax code would allow you, or the financial accounting standards would allow you to use that value.
And they'll record an expense for that value. But of course, the amount that the deduction ends up being later when the shares are actually purchased is very likely to be very much different than that, especially if the stock has gone on a tear like Tesla has, in which case the amount of expense that you record in your financial statements will be much lower than the tax deduction that you get from the IRS, which can lead to a situation where it looks like you earn billions of dollars in income as a company, but you don't pay any taxes. And something similar happened at Amazon.
Yeah, and so again, if you're Amazon, you look like you're so profitable because you expensed only the Black-Scholes option price at the date of grant, and you did never expense anything else. And again, it's not. I mean, some people would disagree with this financial accounting treatment, but some people agree with it, and it actually becomes a little bit philosophical, as all fine financial accounting questions do in the end, in that you did give something to employees away, but like, what was the value of that thing? Well, when you gave it away to them, your best guess was the Black-Scholes option pricing method value, right? So if I give you a lottery ticket and I bought it for $1 and you end up going and giving it and winning $1 million, did I give you $1 or did I give you $1 million? It's actually not straightforward necessarily to know what the answer is.
But we're not going to answer that because, as you pointed out earlier, we are accountants and not philosophers.
Correct.
Okay.
At least I am.
What else do we need to know about options?
So one thing that I was actually thinking about this, so a lot of Tesla's share price increases come in the last 2 years. And so a lot of the increase in the value of these options to Elon has come in the last 2 years. And it's just been in the last 2 years that he moved locations. And for tax purposes, it really matters where you live. So here's the question for you. Elon got these options when he lived in California. And then Tesla and Elon both moved to Texas, which has no individual income tax. Was that like a smart tax move? From the standpoint of his option exercise?
Well, the answer was moving to Texas a smart tax move? The answer to that question is yes. From the stock option exercise point of view, I think it's going to create a complicated mess, which will probably require his accountants, his real accountants, not his academic accountants, to figure out, because he will probably end up paying tax, some to California, and he won't have to pay any to Texas because they don't have an individual income tax, is my understanding. So he'll still have to pay some to California, but probably not as much as he would have had to pay to California if he would have stayed in California. Did I get it right?
Yeah, I think, there's different ways to allocate it. My understanding is, let's say there's 10 years total, let's say for simple purposes. If he was in 8 of those years in California and 2 in Texas, then he'll pay 8/10 of the value to California. Luckily for the Californians.
What would you do if you were clever Elon, always looking for a battle? How might you instead choose to allocate to the California?
This is where you need some fancy lawyer that's much smarter than me, but the laws, I understand, you just have to allocate it in some way. And, he has not increased share price equally over those 10 years, right? You could argue that his job was to increase share price, and he's really done that the most effectively in the last 2 years, mostly since he arrived in Texas. Likewise, his job is just to produce cars. And he's mostly produced all the cars at Tesla in the last 2 years. But my guess is there's some pretty rigorous laws given all the options that are granted, and California is not going to allow any messing around. And they're way ahead of us on this one, is my guess.
So it would be pretty fascinating if he were able to argue it's based on where the cars were produced, so it should all be allocated to Texas, and California would get off with nothing
When the cars were produced.
when the cars are produced. Yeah, exactly.
Yeah.
But I doubt that's going to happen. He's probably going to be paying a hefty chunk of change to the Californians
Yes.
in the billions.
With a B.
All right, with a B. All right, what else do you want to know about options?
I don't know that I have a whole lot else, actually.
Well, all right.
What do you have for me?
What do I have for you? All right, I want to issue a challenge to you.
Does it involve eating hot dogs?
No. And it doesn't even specifically involve options, but it does involve taxes. I'm going to give you 1 week to decide whether or not you accept my challenge. And then if you accept it, we'll go like 1 more week, in which case we will follow up on the challenge. All right, are you ready?
Sure.
My challenge is, I know that you are a little bit of a poet and a songwriter. My challenge to you, I want to have the Tax Chats sing off. Okay? And
who can sing loudest? Because I
Nope.
can win that.
Nope. Here's what we're going to do. I'm challenging you to write a song about taxes, preferably some current tax event. It can be Elon and his options, or it can be something else, like something that's going on with the reconciliation bill of the Build Back Better plan from Joe Biden, or something, anything. All right. And I want you to write the lyrics to the song, and then put it to a tune of your choosing and sing it. I will likewise write a song, and I will put it to a tune, and I will sing it.
Can I accompany myself on my lute?
What's a lute? I thought lute was money, like filthy lucre. Lute.
No. This is an instrument, Scott.
What kind of instrument is a lute?
It's a lutey kind of instrument.
Okay. Yes, you can use your lute. A musical instrument would be fine. I might use a guitar, and I might not. Do you accept my challenge, or do you want to think about it for a week?
I'll think about it. I need to practice on the lute.
All right. So join us next time on Tax Chats to find out if Jeff has been willing to take me up on the tax song challenge. And if he has, then the following week, or somewhere in that vicinity, we will determine, or we will engage in our competition and see who wins. If he doesn't take me up on it, then you'll just have to dream or imagine what it might have been like had we had the tax singing challenge, which might be better for the listeners if they just imagine how we sing when we sound when we sing, instead of us actually singing. What do you think?
Sounds good.
Okay. I think that's it then. We've covered options. If you have any additional questions, you can always email us or contact us in other ways. Tweet us. We're now on Twitter. I think I'm at Scott Diary, and Jeff is at
Jeff L. Hoops.
At Jeff L. Hoops. Tweet us a question. We'll address it on Tax Chats, and we'll talk to you next time. Goodbye.
Goodbye.